All right, today we're jumping into the latest from KKR Real Estate Finance Trust. You'll know them as KREF. Now, at first glance, their Q3 results, they looked like a pretty big miss. But the way the market reacted, well, that told a totally different story. So let's get into it and figure out what's really going on here.
Okay, so let's dive straight into the numbers. And yeah, right off the bat, the headlines, they were not pretty. It really looked like a clear miss. But here's the thing. If you just scratch the surface, you find this whole other story about underlying strength, and that's the story the market decided to listen to.
So check this out. These are the numbers that got everyone's attention. Distributable EPS, which, for a company like this is super important, it's basically the cash they have for dividends, it came in at a loss of 3 cents. That was a 10-cent miss compared to what analysts were expecting. Revenue fell short too. But, and this is a big but, that loss was pretty much all because of one thing. A $14.4 million realized loss when they had to take over a property. And then you look over at the GAAP EPS, the official accounting number, and it was actually positive. So right there, that's your first clue that the headlines are kind of misleading.
And this right here, this is the number that really matters. This is what the market zoomed in on. Despite that ugly earnings miss, the book value per share, which is pretty much just the net worth of all their stuff on a per-share basis, it barely moved. I mean, it only dropped 0.4%, holding strong at $13.78. For a company whose entire game is owning real estate, seeing that kind of stability, that's the signal everyone was looking for. It says, hey, the core portfolio is solid.
And you can literally see the market breathing a sigh of relief right here in the trading data. Look at that. The stock popped almost 4.5% in the pre-market, and the volume was just massive. We're talking way, way above average. This was not a normal trading day, folks. It's so clear that investors just looked straight past that headline loss, grabbed onto that stable book value, and saw it as a sign that things are actually okay.
So, okay, the portfolio is stable. We got that. So what's the next move? Well, that brings us to the core of what management was trying to communicate on the call. And it was all about a big strategic pivot. They're shifting from playing defense to finally getting back on offense.
And they laid out this really clear two-part strategy. First, on the defensive side, they're focused on cleaning up their real estate-owned portfolio. You'll hear that called REO. That's basically the handful of problem properties they've had to take back. But then there's the exciting part, the offense. They are not just sitting around, they're putting that capital back to work, originating new, better loans. They're even expanding into Europe for the very first time. And get this, they're cutting their own borrowing costs. It's like they're hitting the gas on growth from all sides.
And that whole Europe thing? It's not just talk, it's already happening. Just this past October, they officially planted their flag over there. They closed their very first deal, a loan on a portfolio of industrial assets in France. I mean, this is a huge milestone. It opens up a completely new avenue for growth, a whole new engine for the company.
And they are not messing around. Management is guiding to over $400 million in new loan originations just for Q4. That is a massive signal that this pivot to offense isn't just a plan for the future, it's happening right now. They are putting capital to work.
All right, now for my favorite part, the Q&A. This is where the analysts really get to grill management, and they did not disappoint. They really honed in on the timing of this whole pivot. And, the big question, how long until we actually see this translate into real earnings? So the first big question was about something that looked a little strange in the Q3 numbers. See, the company got paid back on almost $500 million in loans. That's a lot of cash coming in the door. But they only originated a tiny fraction of that in new loans. So of course the analysts are asking, wait a second, are you guys actually getting defensive, or is there something else going on?
And the CEO, Matt Salem, he was pretty straight up about it. He basically said, look, it's just a timing issue. That huge pipeline they have for Q4, a big chunk of that is because their first few European deals just take longer to close. It's more complex. He was really clear, this is not them pulling back.
Okay, the next huge topic was that REO portfolio, those problem properties we talked about. This is a real drag on earnings. Management themselves said there's about 13 cents per share of earnings power just trapped, sitting there doing nothing in these assets. To put that in perspective for you, that is more than half their quarterly dividend. So yeah, you better believe investors are asking, so when are we going to unlock that cash?
And you know what? To their credit, management didn't duck the question. They laid out a really detailed, multi-step plan. They said, look, we think we can get about half the value back in the next 12 to 18 months. That's from stuff that's easier to sell off, like individual parcels or condos. But the really big ones, an office in Mountain View, a life science building in Seattle,
Those are going to take longer. They need those specific markets to get better. The key thing here isn't to get hung up on the exact dates, it's the transparency. They're giving investors a clear roadmap, even if it's going to happen in stages.
So, let's pull all this together. We've got a messy quarter on the surface, but the market loved it. We've got a company shifting from defense to offense. So what does it all mean for the stock? Let's break down our take on the whole investment case right now.
You know, the story for KREF right now is perfectly balanced, like it's on a knife's edge. On the one hand, you have the bulls. They're looking at that stable book value as an anchor, they see the clear pivot to growth, that big Q4 pipeline, and the roadmap for getting earnings back. But on the other hand, you have the bears, and they're just pointing to the hard facts. Right now, earnings don't cover the dividend. And this whole turnaround story, it all depends on management pulling off a pretty complex multi-year plan without any hiccups. And honestly, both sides have a really good point.
And because things are so balanced, we're initiating a rating on KREF at Market Perform. It's not a buy, it's not a sell. The reasons to be excited, those growth catalysts, they are absolutely real. But they are pretty much perfectly offset by the drag on earnings we're seeing right now, and the very real risk that this whole recovery just takes longer than everyone hopes.
So what should you be watching for on the next call? Here's what we're predicting. First, originations. We expect them to hit that $400 million target, maybe even beat it a little, as those European deals finally close. Second, earnings. We think distributable EPS will get back into positive territory, but it probably still won't be enough to cover that 25-cent dividend. Not yet. Book value? That should continue to be the rock, super stable. And the stock price? Honestly, we see it trading in a range for a while. It's waiting for a real catalyst, something concrete, most likely the news that they've successfully sold off one of those big REO assets.
So at the end of the day, KREF has laid out a really clear path forward. The conversation is no longer about whether they'll survive. It's about how fast they can execute this turnaround. The next few quarters are going to be absolutely critical in telling that story. And of course, as always, please remember this is not financial advice.